Once you've started earning, you are going to get advice about investing from pretty much everybody. Your parents, your friends, your relatives, your colleagues. Everyone is going to tell you what to do with your money and what are the nice things to do. You will find people buying homes. You will find people trading stocks. You will find a new IPO being discussed and everybody investing and applying for this IPO. Soon enough, you're likely to find that you're holding a whole range of things. Some gold here, some stocks there, some mutual funds, some bonds, and you have a house on which you're paying some EMI. There is really no method to that madness. But you still think you have a lot of assets and you have a lot of savings. You will get yourself into a problem when you find that you want to go abroad for that postgraduate degree and you find you can't quit your job because there is an EMI to pay and you can't sell few windows and doors of the house to fund yourself. So you have built investments without taking into account what you might be requiring in the near term and in the long term. Investing requires strategic orientation. When you're young, you actually have about 60 years. If you're 25 and you hope to live till 85, you have 60 years of having to deal with your wealth. You need to have a strategic plan about how you want to get there. And for you to achieve this, you need to get a sense of three things: return, risk, liquidity. If you asked any investor, what do you want from your investment? The simple answer is, I would like the maximum return, minimum risk, and highest liquidity. Let us tell that there is no investment that meets this requirement. I have seen young investors coming and telling me that I like to invest, but I don't want to lose any money, which means you're not taking any risk. So it's important to be able to divide your investments or take a strategic orientation which tells you what is realistic, what is the nice way to balance these three things when you try and invest. If you invested conservatively or if you invested to preserve what you have, that will be your first requirement. Young investors many of the times will want money soon enough. You know, there is a marriage coming up, or there is a party, or there is a holiday. So there will be requirements for money which will come unexpected. So to begin with, most of the portfolios should have a low risk and a lower return orientation or have a preservation objective. So starting off with some deposits, with some saving schemes, with a little bit of gold, they might be a helpful thing to do. Some debt funds if you like to add to them, which means these are investments you can pull out when you like, and they are a building block to be able to do what you like in the long term with your money. So you want to begin with a wealth preserving portfolio which has a stable level of return and which has high liquidity, which means you can take the money out whenever you require and a low level of risk. But that is just the beginning. The next layer you have to add to this is an accumulating portfolio or assets that will grow in value over a period of time. You can't build this portfolio without taking on risks. So your investment in equity funds, your investment in long-term debt funds, your investments in property, all of these are investments which you should be able to hold for a fairly long period of time, 10, 15, 20 years of time. And these are assets that will grow in value. It is important that you are not touching these assets but letting them be. You're taking benefits of time, you're taking on some risks in the short term, but they appreciate in value over a long period of time. So a small portion of your wealth when you start off should be in this accumulating portfolio, and as you grow in your career, as your income becomes better, the amount you will contribute to this portfolio will keep growing up, and this is your buffer for your long-term wealth and well-being. So what about those stock tips, those IPOs and those magical tips and tricks to increase your money? Now those should be your wealth maximizing portfolio, which means these are high risk and they can provide a high return sometimes, but they can also provide a very low negative return. Very small amounts of your money in early stages of your investing should be in these products. You should not stake everything and the kitchen sink on these products, because you might erode what you have built by taking a punt at stocks and derivatives and commodities and speculative positions. You have a lot of time on hand to build your wealth over your lifetime. You don't have to be in a hurry or with that anxiety to build it all in those initial years. Build it step by step and build it over time to ensure that you've preserved, accumulated and maximized your wealth through your lifetime. And importantly, don't try to do it yourself. After all, you're not tailoring your own clothes. If there is a task that requires expertise, you are finding someone else who can do it for you. Seek the help of a financial advisor. It might help in building your long-term wealth.